Recently, I bought a company that I believe checks all the check boxes for me as a personal investor. And those boxes are for value, for growth, and for capital reallocation. The company I'm talking about is Tidewater, TDW. I'm going to go through their business model, their business services, their moat, if they have one, their whole investor presentation, and the key points that we need to take as investors if we want to take an investment stake in this company. I will also go through the risks associated with investing in this company. So we're going to get a holistic view of this company and if they are a good investment or not. With that, let's get straight into it. So looking at their chart, you can see that they had a recent run up from $31 to approximately $64, and that was a 105% gain. And then since that time, they have dropped off from that level to about $47, and now they're hovering around $50. And that was a drop of 25.6%. And I attribute some of the recent rise to their earnings beats on earnings and revenue. They beat by 36.66% on May 5th of 2025, and they beat revenue by 2.87%. And then in August, they beat by 178.85% on their earnings and 6.14% on their revenue. So they really ramped it up, and you can see the huge fair value gap that was caused by that. And I think Wall Street thought they rose too fast, too quickly, and they've been settling in and going down ever since that point. What is Tidewater? What do they do? What is their business model? What is their services that they offer? So Tidewater is the premier global OSV fleet, and OSV stands for Offshore Support Vessels. So their boats and vessels support the oil rigs and any offshore projects that are done by governments around the world. And they can provide people, they can provide tugboats, they can provide drilling and cable laying. They can do a lot of things that these offshore rigs and oil rigs need to have in order to operate smoothly and efficiently to produce oil out of the seabed. And I'm looking at their investment presentation right now. You can see that they are the largest offshore support vessel operator in the world. So they have a global footprint, strong international footprint with a presence in every major market. You can see on this global map that Tidewater does business in North America, South America, Africa, Europe, Middle East, where there's a lot of oil. The vessels provide support for offshore E&P, which is exploration and production, subsea, offshore construction and wind activities. So they've recently gotten into renewables, offshore wind projects. So that is kind of diversifying their base already, including towing, anchor handling, and transportation of supplies and personnel, construction, and seafloor evaluation. So they're kind of an integral middleman that these oil rigs, these wind projects, all offshore, need to have in order to operate. So looking at their company highlights, you can see that they own 211 vessels. Some of those vessels are not OSVs, such as crew boats and tugboats and maintenance vessels. They have 18 hybrid vessels, which is the largest in the world. They have 68% high specification OSVs. They have around $600 million in liquidity, 12.8 years average. And this is important because these boats take a long lead time to build, to plan, to build, and to deliver, years on average. So having a relatively young fleet is very important in these type of businesses. So their average age of their vessels is 12.8 years. They have $557 million in EBITDA, that's a 2025 estimate, and $2.4 billion market cap. So you can see where this is leading up to, a very, very small market cap with large potential free cash flow. These are the type of businesses I like to get into. 0.5x net debt to estimated 2025 EBITDA, which is really low. In this slide, you can see that they have the largest number of vessels and one of the lowest fleet ages. And it's broken down by high specification OSVs, which is the dark blue, and other OSVs in the light blue. And average age is the circle, is the orange circle. Customer base has some of the biggest names in offshore drilling, and those are like ExxonMobil, Oxy, they have BP, Total Energy, Chevron, Shell. These are some of the biggest oil names in the world. These are the biggest oil names in the world. and those are their customers. So there's no shortage of revenue that they could potentially get. Some of the most important things are their day rates. That's how much they charge per day for a vessel, and the gross margin that they can produce from that revenue that they're getting. And so you can see that their performance is going up and up. And this is why their stock price also jumped up. You can see there are significant improvements in day rates and cash margins, where gross margins is in orange and day rates are in the blue. And they have been charging more and more because they have a higher graded fleet, and they're just able to charge these companies more. Now, management has told us that the short-term outlook for 2025 offshore spending is more limited, but they're very confident in the long-term outlook for international and offshore markets being strong. The offshore market demonstrated robust growth across most major basins in 2024 and was especially pronounced in Brazil and West Africa. So they're not relying on any one particular geographic location. They realize all of it's important, offset some weakness in one place with strength in another place. But they're saying that they saw robust growth in 2024. The other major thing that we need to look for and keep monitoring in this business is global OSV utilization. So we need to see how much of their fleet is used, how much is sitting idle in dry docks. And to make revenue, they need to be used. They have a day rate, so they need to be in use and serving these major oil companies. And that way they can maximize their revenues, they can maximize their net income, they can maximize their gross margins and net margins. So here you can see anchor, handling, towing, supply vessels greater than 4,000 brake horsepower are almost 85% active. There's very little idle time, much less than their active time. Utilization has been going up and that sits around 75% right now. Adjusted utilization is 90%. That's very high utilization rates. Now, one of the factors going into an investment into this company involved me looking at the shipyard capacity and order book status for the past few years. And global shipyard capacity is down 57%. It's a peak in 2008, which means that there are fewer and fewer shipyards and vessels that can provide the OSV capabilities to these oil rigs. Now, the global OSV fleet, vessels that are less than 25 years old, is going to contract by approximately 40% over the next decade. And this means that vessel capacity is going to shrink even more and put Tidewater in a great place because of their vessel age. So to recap, Tidewater is the leading supplier of OSVs to oil rigs and wind offshore projects. They are a very low fleet age for their vessels, and they operate globally. Now let's look at their finances to see what I'm seeing in this company. So here we have their historical and projected financial profile. And you can see that their revenue has been ramping up since 2021, and they've been getting better utilizations and day rates, and they've been able to charge and get more revenue. So I have this slide which explains that the pro forma for the July 2025 notes issuance of $650 million, which was used to repay the majority of existing debt capital structure. So in July, they refinanced the majority of their debt. They issued $650 million of 9.125% senior unsecured notes due July 2030. They used the proceeds from that to repay the existing senior secured term loan, and this funds the redemption of the company's outstanding 8.5% senior secured bonds due 2026 and its outstanding 10.375% senior unsecured bonds due 2028. So they simplified the debt structure immensely. They pay the premiums, accrued interest, fees, and expenses related to the term, loan payoff, and the redemption of its two previously outstanding bonds, explained here. Entered into a $250 million revolving credit facility, which is not drawn. They have not taken that debt. It just gives them more flexibility to do what they need to do. What are they doing with all of this money that they're going to be generating from this higher day rates and higher utilization? It goes into the thesis number 2 I have about this company. It has been reinforced by what the management has done. Let's look at their investor earnings call to see what I mean about that. So here in their earnings transcript, they say that the board of directors has authorized a $500 million share repurchase program, which equates to over 20% of the company's closing market capitalization. Now that's huge. So if you're buying back a fifth of the company, that's going to have a big impact on the EPS numbers going forward, especially if you're increasing revenues and earnings, and then reducing the denominator of the shares outstanding. You're going to have a huge jump up in EPS. And EPS is one of the metrics that analysts use to determine valuation. So if you see a huge jump up in EPS, analysts are going to re-rate this and give it a higher multiple as the earnings go up. They go further and say that their repurchase philosophy has changed because they were limited by the debt constraints that they had before. On a market cap of 2.4 billion now, as I record this video, that's a huge impact on the EPS and the valuation. They go on further to say that we won't be utilizing our revolving credit facility to repurchase shares, and our capital allocation philosophy still prioritizes acquisitions over repurchases when such acquisitions add more value to our equity holders. This means that they are totally aligned with equity holders, which are shareholders. And basically what they're saying is, we're not going to take our debt to buy back shares. This is something that companies like Domino's does, where they issue debt leverage to buy back their own shares. And the final thing I want to point out in this transcript is that, fortunately, the longer term cash flow out for the business is such that we can likely execute on both acquisitions and share repurchases. That is huge because they feel like they can do both. And they've already shown that they can do both. They already approved a $500 million buyback. And the primary focus is mergers and acquisitions. Now, what are the risks in here? This sounds like a layup, but there are always risks in investments. Well, one of the risks is that oil demand stays weak and that oil supply remains very strong and actually an oversupply of oil, which would lead to all of these big oil drillers to cut back on production because they're not going to put out more oil if there's already an oversupply in the market and get pennies on the dollar for that barrel of oil. So they don't want to do that because they want to maximize their own revenues. So you can see that big oil gives a stark warning. This is from 2024, but big oil gives a stark warning as peak crude and major supply surplus is expected by 2030. So weak demand with strong supply is a recipe for low prices. Growth was on track to slow down before reaching its peak near 106 million barrels per day by 2030. At the same time, the IEA expects total oil production capacity to surge nearly 114 million barrels per day by 2030, a whopping 8 million barrels per day above projected global demand. It warned these dynamics could have significant consequences for oil markets. Yeah, so basically I'm explaining that oil prices will stay relatively low into the next decade. But the source of the oil is also important. So most projections say that US shale oil, the Permian, is going to peak in mid to late 2020s and then leveling off and declining toward 2030 and beyond. And this is important because you can get oil from shale grounds on land, or you can drill in offshore drilling areas. And so if the shale oil is going down in supply and will plateau and start declining, that gives an opportunity for offshore drillers to get more oil. There's a lot more untapped oil in the seabed than on land. But 2030 and beyond, we could see a nice increase in long-term growth for the OSVs supporting these oil drillers offshore. So finally, I want to do a valuation using my software on Tidewater. And so currently their price is around 50, it's 48.77. Their PE ratio is a very reasonable 12.77. But what stands out to me is their forward PE, according to analysts, is 36.36, which is almost a triple of the PE ratio right now. So analysts are expecting to put a nice multiple, a way larger multiple on this business because of the growth that they had in the last 2 quarters. Now, looking at their financials and the charts here, you can see that the revenue was going down and then came down sharply in like 2014, 2015. And that's due to oil prices collapsing at that time. And so they're still recovering from there. But now, recently from 2021, you can see that they've been climbing steadily back up to revenues they haven't seen since 2014 and 2015. That's a 10-year gap of their revenues coming back up. Then their net income dropped massively because of that huge oil drop and went negative in 2017, but has recently become positive and come back up. EBITDA, same thing. EPS is getting positive now, and I anticipate this to go up from now on with their increased utilizations and day rates. And if they continue to do share repurchases, that should boost their EPS. Their balance sheet, this has yet to be updated with their recent refinancing. Shares outstanding, let's look at quarterly. You can see that they had a jump up in shares way back when, but now that they're doing this, have more free cash flow on hand, they can start buying back shares, and that's what they've started doing. And this does not take into account the new $500 million share repurchase plan. So I've been playing around with the numbers, and analysts are anticipating 4.5% revenue growth for 2026, and I put 7% across the board for 2027 through 2029, and that leads to a literally a double of this company based on the current price, which is a great return. And then if we go to the multiple of earnings valuation, you can see that I put 8.7% across the board for net income growth. And with a P, they say a forward P of 36.36. I did 35 for the rest of the years. So more than a triple to the years in 2029. 1 year price target is $61, which is a 25% increase. So it's 25% undervalued by 7 analysts. And then the current price to earnings is 12.8x. And that's very reasonable for a company like this, and much better than the S&P 500 average. So what am I doing with this company? I've started a tracker position in this company. I bought $500 worth of this company. I continue to plan to DCA into this company. I think we have a bit of time based on the oversupply of oil and things like that to the end of the decade. But I do want to start ramping it up, concentrating this position, because I do feel like if they continue to post really strong revenue growth and earnings growth that beat analyst estimates, and they continue to buy back their shares, I mean, their EPS numbers are going to be very large, and analysts are going to re-rate it much sooner than 2030. So that could jump up the price into the hundreds of dollars. So I'm planning on concentrating this position, but DCAing so that on any weakness, I will be adding shares. Thank you for sticking with me through this analysis of Tidewater. If you like this content, please like and subscribe, and I'll see you guys in the next one.